Can't you hear the sound that's in the air? It's rock and roll. 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 It's rock and roll.
And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning. Welcome to the Hump Day edition of The Real Investment Show. Of course, it's Wednesday, wrapping up the week, the day before the big presidential debate. That's tomorrow night. So who's watching? I'm just curious. Just curious who's watching. So anyway, tomorrow night, of course, will be old guy and old guy debating on policies that affect all of us other people. So that's going to be the big topic for the next 24 hours. Anyway, a couple other things out this morning. We're going to be talking a little bit about consumer confidence. Consumer confidence came out yesterday, and there were some kind of interesting dichotomies in that report. So we're going to go through some of that this morning. Also, few other things kind of going on. I've had a few market transactions, of course, the last couple of days. And as we talked about yesterday, the big conversation on Monday was this big decline in Nvidia. Of course, Nvidia had a very big rally yesterday. So. And we talked about that yesterday morning, is that, the stock was coming down, testing support, likely get a bounce. Now, if you need to reduce that position, you're probably going to get that opportunity here in the next couple of days. Probably have a reflexive rally here, then probably a bit of a grind here for a while. So if you need to reduce your weight in Nvidia right now, kind of target, and this is what, as we talked about, we're coming up at the end of the month. So a lot of portfolio managers will be doing the same thing, rebalancing their positions back to target weights in their portfolios. So we could see a little bit more volatility this week as we begin to wrap up this month. And of course, starting on Monday, it's holiday shortened week next week. Obviously, July the 4th falls on Thursday, which kind of stinks right in the middle of the week. I don't know why they just can't make the 4th fall on Friday every year. So,
They move every other federal holiday to
Exactly.
Mondays.
Just make it the 5th.
Yeah.
Anyway, what's the dates, right? They're not that important. Just stick it on Friday. Anyway, holiday shortened week again next week. We just had one last week, so we're going to have one next week. And so, we're going to as the market's on a light trading week, then earnings really kind of kick off in earnest. We'll get a few earnings start to dribble out next week, but big earnings really going to start the week after that. So once we get past the holiday, we're really getting into earnings season. Of course, we're now in peak blackout for buybacks. Say that 3 times fast.
I'm impressed.
And not get canceled.
Right.
So that's it. So, but anyway, we're about to get to that point to where all that kind of buying support we've had out of the market kind of goes away. Again, that doesn't mean you're going to have a correction. It just means that upside for the market becomes a bit more limited, and that's kind of what we've seen here. Just recently, markets have been struggling a bit as that main kind of support of buying, comes out of the markets. Now, one thing I keep getting emails on, and we're going to talk a little bit about this morning in our Before the Bell video, but the market is overbought and can remain that way for quite some time. And this is always, as we talked about on Monday, the 2 mistakes that investors make on a regular basis is acting too early and overreacting. And so they, some headline comes out, some news item, whatever it is, and says, okay, the markets are really overbought or there's some issue with whatever it is. And so investors make this decision to get entirely out of the market or to reduce their portfolios by a large amount. And then markets kind of keep running higher. The other side of that, that's what I'm saying, is like you act too early by making this move, and then you do too much, right? So investing is always about, as we've talked about before, is it's a game of inches. It's making small moves that have an impact down the road. And so, yeah, you're never going to time the market just right. Trying to time exact peaks and exact bottoms of the market's a fool's game. You're going to wind up on the wrong side more often than not. But just allowing the market to relay to you what it wants to do and then acting on that data, you'll do a lot better as an investor over time. So again, just kind of keep that in mind. So let's talk a little bit about the markets, because we've talked about this a bit. I've gotten a lot of emails over the last couple of days. Here's what you need to know before the bell this morning. Markets are overbought, and we can stay that way for a long time. And this is one of the issues that happens with markets is that, Lance, you said the markets were overbought, so I reduced my portfolio by a whole bunch because we're having a correction and the markets just kept going up. Yeah, that's what happens. It's being overbought is a function of momentum. And when there's a lot of momentum in the markets, that's going to drive asset prices higher. Now, even though the market is overbought, it doesn't mean that you're not going to get small corrections back to a support line at somewhere along the way. We tested the 20-day moving average. Coming out of the April correction, we tested the 20-day. We're working on that process again right now. So you have these small pullbacks, which tend to be buying opportunities more so than selling opportunities. But when markets overbought, they can stay overbought for a while. In fact, we've seen this, kind of before. In particular, if we go back and look at this period that we had really kind of from November through really kind of March of this year, the markets just stayed very overbought for a very long period of time. February, March, April, markets just stayed very overbought. Finally, you got that 5.5% correction. And, that worked off and alleviated a lot of that overbought condition. Now we're kind of back up into that game once again. And so this is why it's very important not to overreact and understand that just because markets are overbought, that doesn't mean the markets are not going to go up and go up higher. It's just something to pay attention to, is that when markets are overbought, you're typically closer to getting some type of corrective action. Could be very mild, right? But if markets are very overbought, particularly when they're well extended into overbought territory, you're likely sometimes better just to be a little bit patient, let what positions you have work for you, and then look for those small corrective actions to add money into whatever position you want. And again, kind of a good example of this is Nvidia. And we talked about this yesterday, is that Nvidia had gotten very overbought and was having a correction. The stock was down 14% in basically 3 days. And then yesterday, it rallied about 7%. So again, you have these corrections, even in strong momentum stocks like Nvidia, as an example. You're going to have these corrective actions that'll give you a better opportunity to put the capital to work in those areas. But again, just because something's overbought also doesn't mean that it's going to crash. And so this is why it's important to always remember that markets that are driven by momentum, particularly in the short term, can remain overbought much longer than you think, can go higher and farther than you think, and can really frustrate you to a maximum degree. And this is where we start making mistakes. When the market frustrates us, this is where we make mistakes, right? I'm out, and the market just keeps going up. I've got to get in. And then we typically get in right around the peak of the market, and then you go through a correction. It's like, see, I was right. And now the market's going to crash. And so you get all back out again, and then we repeat this process. So again, don't try to fight momentum. Understand what momentum is, and understand that the market is driven by psychology everywhere, right? It's just a mass organism of millions of people trading stocks every day. And so when you try to make a decision that is contrary to everything else that's going on in the markets, your odds of being wrong are going to be dramatically higher, right? And so then that's not contrarian investing. That's being a contrarian investor is a bit different. But fighting the crowd in the short term, if you're a short-term trader, trying to fight that crowd in the short term, making a macro bet is you're really kind of confusing durations of those theses. So just be very careful. This is how investors get themselves in trouble over time. That's what you need to know before the bell this morning. Come back, we'll talk about consumer confidence. Real dichotomy going on there about what people think and what people think. Talk about that coming up next.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
It's back. Get ready for our next live chat edition of Candid Coffee with Richard Rosso and John Penn, Saturday, June 29th. Anything you want to know, we'll find the answer.
What's going to happen to interest rates?
Should I put all my money in gold?
Has Lance been working out?
Register now and submit your probing questions for John and Rich at realinvestmentadvice.com.
How far will Nvidia go?
What about Social Security?
Who does Mike Leibowitz's hair?
The live chat edition of Candid Coffee with Rosso and Penn. Register at realinvestmentadvice.com. Realinvestmentadvice.com.
Are those your pajamas?
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome to the show this morning. All right, hold on a second here. Having a little computer glitch at the moment. Just give me 1 second. All right. So a couple things that it was interesting. The consumer confidence report came out yesterday, and it was quite interesting in the data that was in that, because this is a survey of consumers, right? And when you kind of expect to survey these consumers, you tend to think that you're going to get some type of consistency, I guess, in that data. And, you know, that doesn't always seem to be the case, and this really kind of, you know, talks to the fact that consumers are just psychological animals like everybody else. And I'm trying to log into my network, and it is arguing with me at the moment. I'm sorry, I don't remember your password. I do. Take it. There it is. So I wanted to share a couple of the charts with you, and so it's fighting me a little bit this morning. Okay, so the consumer confidence, there's two types of consumer confidence measures, right? So there's the University of Michigan, and then there's the Conference Board. And these are two different surveys. I run a composite index. I take these two. I take both sentiment surveys and I combine them together. I create a composite index to give me a bit broader overview of what consumers are thinking and feeling, and tends to give a little bit better forecast than the independent surveys. When you tie them all together, you just get a broader survey, so you get kind of better results. But the conference board is interesting because there's a couple of different aspects that came out of that report. So if we just take a look at consumer confidence, it's been trending lower ever since 2021. So despite this outlook of a strong economy and low unemployment and those type of things, the trend of confidence has been going lower ever since 2021. This isn't really a new thing. The economy was booming back in 2016, 2017, 2018, 2019. I want you to remember this part right here because I'm going to talk about a report that just came out in a few minutes about economists talking about Trump's policies. But I want you to take a look at consumer confidence in 16, 17, 18, 19, and then take a look at 21, 22, 23, 24, right? So very different picture of what was going on within the economy despite, this is the important thing, despite the headline data. Headline data, low unemployment, wage growth, right? All those type of things. Yet this is consumer confidence. And the trend is more important than the number, right? But here's the interesting thing. Their expectations about the future has dropped to the lowest level that we've seen in years. And so again, their expectations so it's not just how do you feel right now? What do you expect out of the economy over the next few years, right? Over the next year or two. That's continuing to get worse. Now, importantly, that spread. So if you take current expectations and subtract them from future expectations, you can get a measure of, kind of the future. And whenever the gap between current and future expectations has been as large as it is now, it has typically occurred going into recessions. But again, this is one of those indicators, like leading economic indicators, like inverted yield curves, et cetera, that don't suggest a recession. We have all these indicators saying a recession's right around the corner, but we don't have any data for it, right? Nobody's saying there's a recession. In fact, the economists right now are unanimously convinced that there is going to be no recession at all. Consumer confidence, and look, I'm going through a few things because this is when I get to this last chart about consumers, you're going to go, what the? So here's consumer confidence about more jobs, right? Remind you, we have a very low unemployment rate right now. Job growth is booming, apparently, according to the government. But consumers have very, very low expectations of more jobs. Which is interesting because if you take a look at the idea about better business conditions, right? So now, what do you think so talking to consumers that are business owners, what is your outlook for business conditions? Are they better or worse? Getting dramatically worse. Right. So again, the point here is that no matter how we kind of look at this data from the conference board, it is an outlook for a weaker economy. They are not confident about the economy, which brings up an interesting point, right? Because when we talk about this economy, there should be some correlation between that and the stock market, right? But the stock market's doing great. And this is the interesting dichotomy. So despite, Mr. Clanton, how do you feel about the economy? It sucks. How do you feel about your job? It sucks. How do you feel about, the world in general? It sucks. How do you feel about the stock market? Oh, that's awesome. And so you take a look at this. This is the conference board expectations for stock prices increase or decrease in 1 year, near the highest level on record in 1 year. And consumers are confident that the stock market will be higher than it is today. Now, here's the interesting dichotomy. That depends on economic growth because the earnings that we're banking on, right? The market's running up on expectations of 20% earnings growth going into 2025. That's a function of economic growth. So you're banking on this idea that the stock market is going to keep ripping off to the moon, but the economy sucks. And those two can't really go together. In other words, you can't have a ripping bull market in a recession, right? Because it's a function of earnings at the end of the day. So it's just a very, very interesting dichotomy. And here, one more chart for you before we get to the break here in a second. Household stock allocations are at an all-time high. So despite the fact that consumers are very bearish on the overall economy, they're extremely bullish on the stock market. Now, this doesn't mean, by the way, the market's going to crash today. If you go back and look at, 55, 60, 65, 70, allocations keep rising over time. So just, and you were at an all-time record then and set higher all-time records. Now now mind you, during that period in the 50s, 60s, and 70s, you had multiple bear markets, 20, 30% corrections. So, but the point is just because you're setting an all-time record on household allocations, it doesn't mean the market's going to crash tomorrow. But it does suggest that, as Sam Stovall from S&P once said, is that if everybody has already bought, who's left to buy? Well, in this case, it's corporations. But you get my point, right? I mean, the households are all in. They are in the game at this point and fully invested, despite the fact that their views on the economy are bad. So again, this is the very, very interesting dichotomy that when we look back in history, we're going to, at some point, whatever happens, we're going to look back and say, man, all the data was wrong and the stock market was right the whole time. Or man, how did we miss that? Right? And that will be the eventual outcome of whatever this dichotomy is. But again, it's just a very, very unusual break between the stock market and what's going on versus what consumers and in particularly consumer allocations to equities are actually doing. And this is, again, just kind of the thing we keep a watch on is, this type of data. And what consumers are doing. This kind of goes back to what I said earlier though in the last segment, talking about momentum and markets and trying to fight the tide. Everybody is in. Everybody is bullish. There is a tremendous amount of momentum behind the markets. You are trying to swim upriver if you're fighting that right now. And I'm not saying you can't win that. I'm not saying you can't win that eventually, but you're going to have to take a lot of bruises and a lot of bangs before you actually win that game, right? And the question, of course, and as John Maynard Keynes once said, is, the markets can remain illogical longer than you can remain solvent. And what he means by that is, if you're trying to short a very strong bull market, you typically run out of capital before you actually win that trade. So, remaining solvent is the key part of fighting that fight. And it's a tough fight. It's very tough, to be a contrarian and to fight something like this is a very, very tough market to fight. So sometimes you're just better off to swim with the current and then just make sure that you swim off to the bank before you actually go over the water cliff, right? So just, those waterfalls can be pretty steep. So just make sure you get out. It's fine to go with the current. Just make sure you get out in time. All right, when we come back, I want to go back and I want you to remember that first graph that I showed you about the Conference Board of Consumer Confidence. And we're going to bring that chart back up after the break. But 16 economists, Nobel Prize winning economists, mind you, have come out and given us a warning. And we'll talk about that right after the break.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
It's back. Get ready for our next live chat edition of Candid Coffee with Richard Rosso and John Penn, Saturday, June 29th. Anything you want to know, we'll find the answer.
What's going to happen to interest rates?
Should I put all my money in gold?
Has Lance been working out?
Register now and submit your probing questions for John and Rich at realinvestmentadvice.com.
How far will Nvidia go?
What about Social Security?
Who does Mike Leibowitz's hair?
The live chat edition of Candid Coffee with Rosso and Penn. Register at realinvestmentadvice.com. Realinvestmentadvice.com.
Are those your pajamas?
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
The bets are on right now for the Nvidia drinking game.
The Real Investment Show podcast.
Every time Nvidia says the word AI, you have to take a shot.
Same show, your schedule.
By the time they get through the earnings call, half the country will be completely obliterated and it really won't matter what they say their earnings were, which will be just in time for the debates. Exactly.
At realinvestmentadvice.com.
That's a whole other drinking game right there.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Yes, Danny is sick of me and quit. So he is no longer on the show. He has been terminated, fired, because he decided to take vacation. So he's out this week on vacation. I'm actually out. So, and by the way, just heads up, I'm out next week for vacation. And so Danny, Rich, John, Matt, the whole variety of clan will be here. I guess we'll probably pull in Mike Leibowitz along the way as well next week. So
you're here part of the week next week, right?
I'm out the 8th.
Oh, that's a week away.
Sorry, the week after. Yeah. The week after I'm sorry. Yeah, not next week. The week after the 4th, I'm out for a week. So
yes. This will be independent of Lance.
Correct. So, but the show will still be here. Still be going on. Still be talking about stuff. So keeping you up to date on everything. But yeah, this is our last big family vacation with the kids. So they don't know this yet. That's going to be a surprise once we get there. We're going, surprise! This is your last vacation with the family. You're on your own now. You want to go, you pay your own way after this one. So, but yeah, so anyway. Yes, I agree with you, Josh. Vacation is unacceptable. Vacation should not be a thing. I don't know who thought this idea was a good idea to provide vacations. It loses so much productivity. But anyway, absolutely agree with you. And yes, markets tend to crash while I'm on vacation, by the way. Just heads up. It's for 30 years, every time I go on vacation, the market crashes. So just be aware. If it doesn't happen this time, it'll be a first, I think.
That or the studio floods.
No, that's right. Or the studio floods, something bad happens when I leave on vacation. So just be aware that is a potential. Okay, so let's go back to that chart I showed you to start with at the beginning of the last segment, which is this chart of consumer confidence. Now, I want you to take a look specifically at 2016, 2017, 2018, 2019 versus 21, 22, 23, 24. Okay, big differences. Now, I want you to set everything else aside for a moment and let's just talk about what was going on during those previous 4 years and the current 4 years. So in those 4 years, we had, yes, this was the Trump administration, love him or hate him, but we had tax cuts. We had the TCJA tax cuts that were started in the December of 2017. We had in 2018, of course, we were doing tariffs on China. We had locked down the border. We had done a lot of things, right? And market was doing fine. Of course, we had, the Fed was hiking rates in 2017, 2018. They cut rates going into 2019. Of course, we had the pandemic in 2020. So, regardless of who was in office, you can't really say, well, the shutdown of the economy, it wouldn't have mattered. If the Democrats were in office, they would have shut down the economy. Republicans were in office, they would have shut down the economy. Everything that happened in 2020, that was going to happen for the most part because it was global. It wasn't just the U.S. shutting down the economy. It was global. Everybody did it. So it didn't matter whether you were right or left or whatever politically, right? The economy was getting shut down, period. So that really is not a policy issue. So we're going to set aside that 1 year. Just for this conversation, we're going to set aside this 1 year because this is about policy, right? What policies were in place? And so we're talking about tax cuts. We're talking about, job growth, those type of things, right? So what policies were in place? Tariffs, those type of issues. The reason I'm bringing this up is because there was a very interesting article this morning on CNBC. And the headline is 16 Nobel Prize winning economists warn a second Trump term would reignite inflation. So here, let me just read to you this, a couple of sentences here. 16 Nobel Prize winning economists signed a joint letter to warn of the economic risks they see in a potential second term of Donald Trump, including reheated inflation. Many of these same, and of course, they're talking about the risk that a reinstatement of tax cuts and imposed tariffs are all going to be very inflationary for the economy. But during that previous 4 years, when we had tax cuts and tariffs, we didn't have inflation. We didn't have a spike in inflation. Spike in inflation came when we shoved, $5 trillion worth of stimulus into the economy and shut the economy down, right? Supply and demand. So there's not really any evidence that tariffs and tax cuts lead to inflation, but this is the interesting thing, right? So here's of course, this was Axios, which was the first to report this, and then CNBC picked this up. Axios, of course, a very left-leaning organization. There is a rightly, I'm reading to you directly from the quote, and so forgive the grammar. There is rightly a worry that Donald Trump will reignite this inflation with his fiscally irresponsible budgets, wrote the group of politically progressive academics. Trump has so far proposed making his first term tax cuts permanent, right? So that's the TCJA that is sunsetting. imposing universal tariffs on imports with a China-specific tariff between 16 and 100%, pressuring independent Federal Reserve Board to cut rates. Well, everybody's pressuring the Federal Reserve to cut rates, so that's not a Trump thing, right? So, yes, Trump pressured Powell to cut rates. Everybody else is pressuring Powell to cut rates, so that's not a policy, right? That's just, people want lower rates because we have a highly indebted economy, and you need lower rates to help boost economic growth. But there's no evidence that from these economists that the TCJA and tariffs actually lead to inflation. There's an argument to be made for it, right? Because if I impose a 100% tariff on a Chinese product, then I'm going to pay 100% more for that product that I'm importing from China. So that's inflation, right? But what happens? The reason that tariffs don't necessarily, now there's arguments for this on both sides, but a reason that tariffs don't necessarily lead to inflation is that consumers say, okay, I'm just going to buy that product, right? So it's supply and demand, right? There's no demand for the product. Great. Nobody buys it. Or they buy it somewhere else where they can get it cheaper. Somebody else will manufacture that same product, or you'll manufacture it locally. In fact, there's been a lot of onshoring of products and goods and services that consumers can buy, and they can buy those cheaper than they can buy the Chinese products. So there's not necessarily a direct correlation always, immediately, between tariffs and inflation. Inflation's a much broader issue. Again, 44% of inflation is simply housing. So again, tariffs don't necessarily mean that's going to reignite inflation on some products that you're imposing a tariff on when 44% of inflation is driven by housing. Now, lower rates. You start cutting rates, you bring the mortgage rate down to 3.5%. Maybe you get an ignition in home prices because now all of a sudden there's a huge demand. But there's an interesting argument that cutting rates and bringing mortgage rates down might actually cause a decline in home prices, because the problem with home prices right now is a lack of supply. Boomers are locked up into their houses because they have low mortgage rates, and if they wanted to sell their house and go buy a new house, they're going to have to buy a smaller house because it's going to cost a lot more, and their mortgage rate's going to go up. And so they're just sitting tight. So one of the arguments is that when rates do come down, there's all of a sudden a flood of supply onto the market for baby boomers wanting to downsize. And now they can make that swap and keep their mortgage rates basically the same. So we'll see. But now here's the interesting thing about this is that, there's a lot of interesting comments by, this group of economists talking about, warning about this second term. But it was interesting because these same economists in September of 2021 signed a letter in favor of President Biden's Build Back Better investment package, saying that there was no risk of inflation. So they supported the very thing that was a political argument, saying, hey, this is going to be good, right? Won't create inflation, it'll be fine. So they supported those policies, but they don't like Trump's policies. So, you've got to be careful. And the reason I bring this up is you've got to be very careful because you're going to see this stuff. And this is a very partisan group of economists promoting their political opinions, and that's fine. There's nothing wrong with that. We live in a constitutional republic. That is your right. You have freedom of speech. But as an investor, be very careful reading that type of data and then making an assumption about the market on it, because they were wrong both times. So again, this is important. Separate out, politics are fine, but keep your politics out of your investing because those don't mix in a lot of cases. All right, quick break. We'll come back. A couple of other interesting articles for you this morning. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
It's back. Get ready for our next live chat edition of Candid Coffee with Richard Rosso and John Penn, Saturday, June 29th. Anything you want to know, we'll find the answer.
What's going to happen to interest rates?
Should I put all my money in gold?
Has Lance been working out?
Register now and submit your probing questions for John and Rich at realinvestmentadvice.com.
How far will Nvidia go?
What about Social Security?
Who does Mike Leibowitz's hair?
The live chat edition of Candid Coffee with Rosso and Penn. Register at realinvestmentadvice.com. Realinvestmentadvice.com.
Are those your pajamas?
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So a couple of interesting comments in the chat just while I was scanning them on the break. James Butler says that markets have always done better during Democrats. That's not really true. Some of the biggest routes in the markets occur when Democrats are in control of the House and the Senate. So, and also you have to take in when policies are put into place. Markets tend to lag policy changes. So you also have to go back and say, okay, what policies were passed underneath what president or what Congress and whenever it occurred, and then look forward to see how those occurred. Also, when what policies were passed that led to an eventual recession. So you always have to go back and keep these. You can't just, and this is one of the kind of the fallacies of analysis, which is trying to conflate causation and correlation. And again, what caused the recession? Well, that just didn't pop up out of nowhere. What policies were put into place? And that happens under both Republican and Democrat presidents. It happens under both Democrat and Republican-controlled Congresses. The market actually does the best when it's split because you get no policy changes. So again, just you got to be careful with that data. It's not as clear-cut as it would seem to be. Anyway, so a couple of other kind of interesting stories that are out there this morning. We've talked about AI. Of course, that's been the story about AI as of late, Nvidia in particular. And the interesting story this morning, one of the things I've said before is that one of the big risks to Nvidia is that right now they control a massive market share of the AI chip category. Now, there's other competitors, AMD, Micron, others. Intel, Apple, building their own chips now for Apple Intelligence. But the Nvidia controls that market at the moment. They're the player. But one thing I've talked about before is that eventually that success leads to other competitors who will come into the markets to build similar products, right? So if you have a really successful product, I'm going to come in and say, well, I can build something as good or better than that, maybe sell a little bit cheaper. I can grab some I don't have to grab a lot of market share from Nvidia to make a ton of money, right? I just need a little bit of market share. And this is one of the big fallacies that come along with private equities. You know, when people come say, hey, I've got this private equity investment, you know, come do this. And if I can just get 1% of this $100 billion market, you know, it's going to be $1 billion company. And that's a true statement. But that 1% can be very, very hard to get. But again, this is the premise, right? I don't need to dominate Nvidia. I don't need to put them out of business. I just need a little bit of their market share, right? And I can make a lot of money. And the reason I bring this up is that 2 Harvard dropouts have raised $120 million to take on Nvidia's AI chip. So this was a team that was founded by college dropouts, investors that were led by primary venture partners. And this is one thing I was talking about the other day, is that if you see a private equity deal, like somebody comes to you and says, hey, I got this really great private equity investment, first question is asked, why am I so lucky, right? Because these companies like private, Sequoia Investments and Apollo Investment Groups and the Bill Gates Foundation, et cetera, you know, they do, when they do a raise, it's, you know, they go, hey, I'm going to put in $50 million and I'm going to call 2 of my buddies and they're all going to put in $50 million and we're going to raise you $150 million bucks, and they do it like literally overnight, right? So if somebody's coming to you trying to raise money in $100,000 increments or whatever it is, why are you so lucky? Ask that question. But this is my point, right? So here's 2 college dropouts from Harvard. They have come up with this idea to compete with Nvidia, and they raised $120 million. The company's called Etched. The CEO is Gavin Uberti, and he said the startup is betting that as AI develops, most of the technology's power-hungry computing requirements will be filled by customized hardwired chips called ASICs. So that is going to be the story going forward, which is going to be these companies that are going to pop up. Now, here's the investment problem with this. There's going to be a ton of companies you're going to hear about that pop up, and it's like, man, they're going to go compete with Nvidia. They're going to be huge, right? The problem is we saw this in 2020, 2021, 2022. Remember all those companies that were privately funded, and then all these big private equity companies were trying to get them to go public, and the IPOs weren't working, and so they went to do SPACs. And they were just, you know, they had so much capital, and so we started setting up these SPACs to go out and give me the capital first, and I'll go find these investments. Most of those crashed and burned. Only a very, 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 very small percentage of these companies that are started make it. About 80% of them fail. So the problem with knowing which one is going to be a complete failure and which one's going to be the next Nvidia is more luck than anything else. But that's why, and that's why I had a call with a gentleman yesterday talking about this very thing, is that, you know, if you're going to do private equity, you need to be in with these private equity companies that have the capital. They're seeing the good deals first. By the time that somebody comes to you with a private equity investment, it's nobody else wanted it. You're the last guy on the list. Is like, hey, here's my hat. Can you put some money in it? Be careful. That's all I'm saying. Doesn't mean they're all bad. Just be careful, because if they're a good deal, right, these private equity companies, which have about $3 trillion in cash, are going to snap these deals up. And there's so much money. These private equity companies have a ton of cash that they have to deploy. If they don't deploy the cash, they have to return the cash at some point. And they don't want to do that because they don't make money on uninvested cash. So they are scrambling to find deals to put that money into, which means that a lot of really not so good companies get funding because I just got to get something funded. And if I can fund 50 companies and only one makes it, it pays for the other 49 I lost money in. But that's the game. And the question for you is on private equities, do you have that fortitude to fund 50 companies 49 of them go bust to get one to go be a home run? And probably the answer is no. But anyway, this is a 2-year-old startup founded by Harvard dropouts. They raised $120 million, and they are going to build a competitive chip to take on Nvidia. So we'll see how this works out. So keep your eye out on this company. It's called Etched. And we'll see if they show up in the public markets at some point down the road, or if they die a gruesome death, which typically tends to happen as well. So interesting enough. But speaking of this, and AI chips and those type of things, there was another kind of disturbing article this morning on Zero Hedge, actually, and talking about a company in Switzerland that is building computers using lab-grown brains. So but here's the interesting thing about this. So they're using stem cells derived from human skin tissue to create these 16 spherical brain organoids that the system depends on. And the theory is that these will run computers much more efficiently in terms of electricity usage, power usage, than traditional computers. So if we can make this thing work, then, we can, have all this computing power on a much more efficient basis, which, the power support for all these AI data centers, et cetera, is one of the big key issues to kind of come across. And what was interesting about this article is they have two problems. Or one problem is that the brains die too fast, right? So they grow these brains, they hook them up to the computers, but the problem is they keep dying, and because they're human in a way. So they're organoids and they die, and that's just part of it. I haven't figured this out. And this company, this is a Swiss tech startup called Final Spark, which may be kind of ironic since the final spark is that the brain dies, but they're selling access to these biocomputers that combine up to 4 tiny lab-grown human brains with silicon chips. Here's the disturbing part of this article, right? They say that in order to train the brains, they have to they basically use a reward punishment system. So researchers do this by, I'm going to read this quote. Researchers do this by training the organoids through a reward system. The organoids are rewarded with dopamine. That's the neurotransmitter that is responsible for pleasure and addiction. So if they do the task correctly, they get rewarded with dopamine. So they feel great. Meanwhile, as punishment, the organoids are exposed to chaotic stimuli such as irregular electric activity. So, in other words, if they get the task wrong, they're punished by basically just chaotically, shocking them. So. Now, I know these are just lab-grown brains, but just something seems wrong about enslaving human brains and using a reward punishment system to produce computer technology. Anyway, I think there's a point. Let's come up with a better way for power. How about that idea? Because the next invention of this is like, hey, why grow these things? We got a bunch of people not doing anything now because of AI. Remember the Matrix? Everybody was plugged into the Matrix, right? Just saying, this is how that stuff starts. Have a great day. We'll see you back here tomorrow. Like and subscribe to the channel, please, and send us your questions, comments, emails. Y'all have a great day. We'll see you back here tomorrow.